What's up? What's up, Travis? Let's see if anyone else will join, but we can just begin. Today is pretty small topic, just couple of ratios, final words about the fundamental analysis, basically, because these are the last ratios about fundamental analysis, at least quantitative part of it. And basically, after this, we'll talk about something more interesting than just numbers, formulas, and stuff like this and that. Okay, so yeah, Gabriel is our new member. I know the guy, he is from Canada here, our friend. Let's see if he will join, but he is like very, he basically, as far as he told me, he started watching our previous meetings, since I always record them, put on YouTube. So he's like catching up. Don't know, maybe he's not ready or he is ready. Maybe he's busy right now, but anyways, if he can join later, will be perfect. And Diego, as always, expecting him to join soon, maybe yes, maybe no. Hopefully yes, I mean, but you know the drill. We start, and in between sections, I just allow more people, and that's it. That's how we do. Just opening the presentation right now. Okay, here it is. You're always welcome, Travis. Okay, so yes, where is the share screen and stuff? Photos. Okay, you are sharing screen, it says. Okay, so today, like I said, it's fundamental analysis once again for the last time, but it's the last time speaking about ratios, like numbers, formulas, and all this kind of stuff. So it is still quite useful. It is pretty useful. I would even say not just quite useful, but this may seem boring maybe for some people, because like I said, this is just plain numbers, plain formulas and stuff like this. But what makes it even a little bit more interesting, at least for me, is the way you interpret these numbers, the way you look at those numbers, and the way, like, for example, if you go online and read all this like news by investing gurus saying like this is this is that, like, yeah, it may be true, it may be wrong, this may be rumors, this might be some like fake news or stuff like this, okay? But numbers, they never lie. Unless person who created the reports, he lied. If the numbers that we see in the financial reports are correct, like that's it, they never lie. This is what's so good about this, like math, numbers, formulas, they never lie. And even though you might see like investing gurus saying like this company is like doing so good right now, and then you just go and see, I don't know, income statement, and then you see that for the last 5 years, every single year revenue is decreasing. Like that's it, like you just realize that this is a clown. And I really see lots of people on YouTube and stuff like this, like not blaming them. I don't know, maybe they just do it for views, maybe they're just unexperienced yet, but like whenever they are saying like top investments for November, top investments for October, and they talk about companies like, yeah, these are the companies that might good be, I don't know, like in the future, whatever, I don't know, like, but most likely, like I see these companies later, I analyze them fundamentally, I check their financial statements and stuff like this and that, and these are not the companies that are supposed to explode, at least in the nearest future. Like, of course, I'm not gonna spend like my whole day reading about the companies, like perspectives, like, and stuff like this, like shareholder meetings and stuff like this, because I already see that the numbers are not good. And whatever strategies they're saying they're gonna use, whatever they're saying that, okay, like since next month, I don't know, we're doing this, we're doing this, expect trillions of dollars in profit. Like, yeah, I guess like it can be fake news, it can be just empty words or whatever. Because for me, I see the numbers, I see they're doing not so good, even below average. So I don't see they have cash, for example. They're saying like, we're gonna do this thing next quarter. I see that they don't even have enough cash for doing such things. And basically that's it. And yeah, intro got a little bit long. No one joined in in the meantime. Okay, let's continue. So forgot to send the schedule for today's meeting in our Instagram group, But basically, this is what we're going to talk about. What are activity ratios? Like always, we begin with this, explaining basically the topic of the presentation, straight to the point. Then I talk about asset turnover ratio, inventory turnover ratio, and that's basically it. These are the only two activity ratios that at least I am personally using. Then I'll just summarize fundamental analysis really quick, everything we'll be talking about. And in the end, like I said, there is always room for questions. If you have any questions, I will do my best to answer them, but you already know, in between the sections, you can basically ask questions, type them in the chat, or use your microphone if it's some urgent question. I mean, yes. And yeah, I will do my best to answer every single question that you have. And let's begin. Let's continue or begin, whatever. So yeah, no one joined, nothing in the chat. So let's do it. First of all, what are activity ratios? Activity ratios show how effective the management of a company at generating profits while utilizing its own assets. So it may be sound similar like return on assets, because this is kind of the same stuff like return on assets. If you remember, I think it was previous week's conversation. This is the assets divided, I mean, net income divided by assets. Okay. So, and these things, they also show how effective the management at generating profits utilizing its own assets. But instead of net income, it uses mainly revenues. So net income, if you remember, it's the bottom line. It's whatever is money left after everything is paid out. And revenues is whatever money they made selling products, every single cent before they start paying their suppliers, salaries, interest payments, like, and all these kinds of taxes and all this kind of stuff. Okay. So it's kind of close, but you will see the little difference whenever we'll be talking about those two ratios in particular. Okay, and if a company sells physical goods, it shows how efficient is the inventory management. And between those two ratios, asset turnover ratio and inventory turnover ratio, I would say that inventory turnover ratio is the key attention point of this week's presentation, and you will see why. Okay. No one joined, nothing in the chat. Let's go. Asset turnover ratio, first one. And like I said, the formula is revenues divided by average total assets. And as you can see, basically, the only difference here is revenues. And first of all, it's revenues, not net income. And second, it uses average total assets, not just total assets, because balance sheet is basically the snapshot in time. I don't remember if I was talking about this. The difference between balance sheet and income statement in terms of where the data was captured is the following. Balance sheet is the snapshot in time. For example, like you have assets, like you're a small company, for example, like, I don't know, video editing company, okay? You have your camera, you have your, I don't know, like this light equipment, you have like, I don't know, like soundproof studio, you have like table, you have computer, you have laptop, you get the idea basically, yes? So these are your assets. And so, for example, in this, it's November, okay? So the November is usually generally it's fourth quarter, because like quarters in financial reporting systems are basically every single 3 months. So last quarter, fourth quarter is October, November, and December. So technically, if we're talking about this video editing company, whatever we're having right now, these are the assets of November, assets of quarter 4. But for example, you finish the quarter, like you have like Christmas, New Year, like you had good sales, let's say, so in the end of October, November, or December. And then in, let's say, so March and in February, let's say, to make it even easier. In February, which is quarter 1, which is the beginning, the first quarter of the year. In February, you decided to buy I don't know, like one more additional camera. Okay. So previously you had assets worth of, let's say, so $100,000. And you have your financial report, quarter 4 report, and it says assets $100,000. But then next year, in the first quarter of the next year, you bought camera, which is, I have no idea how much they cost, professional cameras, let's say, so $10,000 to make it simple. So whenever you do your Q1 2021 financial report, in this case, your assets will be not 10,000, but it will be 110,000. So it will be whatever amount of assets, whatever assets monetary worth at this very moment. If instead of buying camera, you sold one camera, this means that you will have 90,000 worth of assets in Q1 of 2020. And this is what balance sheet means. It's the snapshot in time. It's how much stuff you have at this very moment. If it's assets, how much inventory, how much equipment, how much salaries you're paying, I mean, how much employees, like assets basically. If it's a factory, if it's machinery, equipment, office equipment, like all this in monetary value at this very moment. Liabilities, this the same. How much salaries you're paying, how much interest payments you're paying, how much taxes you're paying, like whatever liabilities, whatever your payments are at this very moment, like these are all the goes to basically balance sheet liabilities. But income statement at the same time, it's the progress during this quarter. It's not snapshot in time. It's not whatever you have at this very moment worth of something, but it's the result. It's a result of the quarter. For example, if your sales in this quarter for 2020 were like $10,000, for example, okay, but in first quarter of 2021, your sales became $11,000. And no, you do not put in say like, yes, technically saying like your sales of this quarter are $11,000. Let's say so. I'm just trying to see if it makes sense. So it is the progress. It's not like balance sheet. It's like inventory, for example. Okay, you have laptop, and if you don't sell your laptop, this this monetary worth of the laptop, which is let's say so $2,000, as long as you don't sell this laptop, and let's not talk about depreciation because it makes it's more confusing. Okay, so we take this laptop, which is $2,000. As long as you don't sell this laptop will appear in Q1, in Q2, in Q3, in Q4, in Q5, and stuff like this and this and that. It will appear. It will keep appearing as long as you don't sell it. But sales, if you made $10,000 sales in Q4, and then that's it, Q4 finished, and that's it. You start sales of Q1 since zero. Every single sale you start making in your next quarter, it will start from zero. It will not add to the previous sales of the previous period. So basically every single balance sheet, it's whatever we have at this very moment, whatever was in the previous period, it is added in the balance sheet. Whatever new bought, it's added. Whatever you sold, it's subtracted. But income statement, every single income statement, every single quarter of income statement, it starts from zero. And whatever you make sales, how much interest you're paying, how much salaries you're paying, it all adds up since zero. So if it makes sense in this way. So for this reason, we are using average total assets in asset turnover ratio because it is important to know total assets. Like you need to take them from the beginning of the year, then you take total assets at the end of the year and you divide it by 2. And obviously the reason for this is because assets most likely they will change. Most likely some equipment will be sold. Most likely maybe new people will be hired. Most likely, like, I don't know, if it's a big company, you'll acquire new factory. So in the beginning of the year, total assets will be most likely different than total assets at the end of the year. And for this ratio to make sense, because this ratio is good to be calculated on annual basis. So for this reason, it is good. It gives more precise results if you use basically just average total assets. And the higher this ratio, the better. Basically, if you have revenues, let's say, so of $100,000 and your assets are just $20,000, so just take 100,000 divided by 20,000, your asset turnover ratio is 5. But if your revenues are $100,000 and your average total assets are $10,000, so it's 100,000 divided by 10,000, it's 10, which means that both companies generated the same $100,000 in revenues, but second company is more efficient because it had twice less assets. It has, let's say, so I don't know, twice less equipment, twice less factories, twice less this, twice less that, and having twice less assets, they were able to make the same amount of revenues as the previous company. And this is basically as basic as it gets. Let's see if anyone joined. I see 3 questions in the chat. Yes, I was expecting this to be cool. Okay, you should put together a fundamental analysis PDF ebook from all your slides from this series. Basically, I am going along with my book. So this second book, I don't know if you've seen my previous stories for the last end of the last week and this beginning of this week. I was asking people to help me select the title for the book. I go along with my second book. So I went along. I think I don't remember. I have, let's say, it's like 9 or 10 chapters, and I just basically kind of summarize just 3 chapters of the book in these presentations. So as you can see, we spent already like what? We had 10 meetings about fundamental analysis, and it is only 3 chapters of the book, which is like just 30% of the total book. I don't know. I don't want to say the sort of value because I think it's so spoiled, this word, like buy this book, it's packed with value. It's like value bomb and all this kind of stuff. But I guess you see that I spent like couple of months, 3 months explaining just 30% of my book. And yes, you as a Patreon member will get it for free. So don't think I'm selling it to you or anything like this. Even if you quit my Patreon, I'll just send to you for free. I don't mind. You're just a good guy. I don't need to make money from you or whatever. I'll just send to you for free anyways. And so what I'm saying is that yes, I go along with my book, but there's so much more in my book. So basically, definitely, if you're interested, it will be a good read for you. This will be super helpful for me to refer back as a source. Perfect. Yes. And this is the book that is like I said, I just go along with this book, but this is only 3 chapters that I did my presentations based on. So you will be literally able to just read the book and you will see everything basically you already know. So I wrote notes, but spread across 2 physical notebooks now. Okay, yeah. Would love to a digital copy of the whole series to check on my phone, laptop to refer to when I'm looking at stock picks. We literally talk about the balance sheet, cash flow. Yesterday in class, how I taught these documents to my students. Yes. My book, once again, will be released. I'm selecting the title. I kind of streamlined my YouTube stuff. So I'm writing the scripts on, like, say, so Tuesday and Thursday, filming on Tuesday and Thursday, Wednesday, Friday, I'm heavily editing, and then I'm just uploading, basically uploading. On Monday, I catching up on my weekend stuff and uploading something else, maybe stuff like this and that. So yeah, I kind of streamlined my YouTube process right now. So I have some time to edit my book, and I just need to edit a little bit of text, add something new stuff that I learned, because I finished writing this book literally maybe like in May. I think, yes, like May approximately, maybe June, July. And since then, there are some new things that I learned. So I need to edit some texting, to write something new, basically a couple of pages more at least, then completely edit it. This will take maybe a couple of weeks. So I would not tell you to maybe expect the book in the nearest, unfortunately, months, maybe, because also it's like Christmas holidays now, New Year holidays. So will be hard to edit during this time. But like I said, I will do my best to finish it as soon as possible. And then, yes, this book will be very, very, very good for you. And feel free to share it with the students if you want, by the way. I don't mind. So yes, I guess let's continue. Where is the stuff? Okay. Next one is inventory turnover ratio. And this, like I said, what's even more important in this part of presentation, more important than asset turnover ratio, in my opinion. The formula is, as you can see, different. COGS is cost of goods sold divided by average inventory. And cost of goods sold, it is approximately on the very top of the income statement. It is like very close to the top. So cost of goods sold, like if you just think about these words, literally just think about these words, this basically means like the majority of this part of the what is this account, let's say, so like entry on the income statement. Cost of goods sold, it's basically raw material price, let's say so. Okay, like not raw material, but like whatever you're paying to suppliers, majority of this money you pay to suppliers will go to cost of goods sold. Let's say so you are ordering 100 tables, and each table is $100, and then you're selling them for 120 each, but you paid $100 for 100 tables, so you paid $10,000. So this is your cost of goods sold. Like obviously you can include more, like if we're going to how it's called, like if we're going to sophisticated accounting, obviously it's not that easy, but I am here not teaching you accounting, I'm teaching you investing. Like I'm not teaching you how to find cost of goods sold, because whenever you're investing and you're analyzing income statement, this number is already done for you. So you don't need to know where it appears from. Just you need to know at least just the basics, what it means. And like I said, this is how much you paid for this product to be sold. Basically, cost of goods sold. It kind of, if you think about this like whole sentence, cost of goods sold, it's kind of self-explanatory. And so in accounting, because it's very large, it's very long sentence, cost of goods sold, sometimes you can see it as COGS. And so you take COGS, divide by average inventory, and you get your inventory turnover ratio. It shows how fast inventory is being sold. And if ratio is 10, for example, it means that a company sells its inventory completely 10 times per year. So for example, if inventory turnover ratio once again is 10, imagine like very, very theoretical example, but still, imagine a company has a warehouse and it buys warehouse full of stuff and sells it completely, then until it's literally empty, and then buys again, sells it again, buys again, sells again, and 10 times per year. So basically, this is what it means. Inventory turnover ratio shows how many times a company sells its inventory per year completely. And obviously, like it's not like this, like that is just very theoretical example. Companies do not like, let's say so, wait until the warehouse is completely empty in order to order something new. They sell, I don't know, 10% of it, and then they keep ordering 10% of it. They sell small part, then they order small part. So it's always like kind of full. So they always keep reordering and reordering and reordering. But if you think approximately that inventory is estimated at $100,000, so let's say, so you sold 10% of it, 10,000 worth of it you sold, and then just ordered $10,000 more. And as soon as you make 10 such orders, like even though warehouse was never literally completely empty, but because you made 10 orders worth of $10,000 each, you basically renewed your whole warehouse, because once again, you spent $100,000 on your inventory, and basically you sold $100,000 worth of inventory. Very theoretical example, but basically it gives you the basic idea how it works. And if you want to go in further, you can take 365, which is obviously amount of days in a year, and divide it by inventory turnover ratio. And it shows you how long it takes on average to fully sell inventory once. So for example, once again, if this inventory turnover ratio is 10, you take 365 divided by 10, and you know that approximately on average, it takes you 36 and a half days to completely sell your inventory. Like, and as you can already guess, maybe you already started guessing, the most important, this was so important that I even had to do 2 slides for this ratio. It is extremely important for grocery stores and restaurants. And let me see really quick if you have any questions or if anyone else joined. Okay. And it is, as you can guess, extremely important. Just give me a second. Okay. It is extremely important for grocery stores and restaurants because they sell stuff, they sell products, they sell food that gets spoiled. So for them, obviously, it's a matter of surviving for the business. It's a matter of survival for the business to sell inventory fast until food gets spoiled, obviously. Like, this is pretty self-explanatory. So it is very important, and I'll talk about it a little bit. It also, inventory turnover ratio, it also helps managers to forecast order amounts from suppliers. For example, if manager, once again, from the previous slide, we see that on average, it takes 36 and a half days to completely sell inventory. So basically, manager knows that he needs to order new supplies definitely sooner than 36 and a half days expire. Like if they, for example, they sell half of the warehouse and then they order half more, and then they sell half more, then they order half more, then manager knows, for example, that it will take approximately 18 days to sell half of its inventory. And he knows that approximately in every single 18 days, he will need to order around half of its warehouse. So he can schedule like his inventory management, he can schedule order. So he can basically not just call suppliers and say, I need this tomorrow. And suppliers say, we don't have it. So he can place the orders and don't worry, just place orders and that's it. If inventory turnover ratio is high, there is a risk to run out of inventory. High inventory turnover ratio means that inventory gets sold so quick. Like restaurants are selling food so quick that they order supplies, they all order raw materials like raw food, pre-made food or whatever it is they're selling. They're ordering less than they're selling. And for this reason, obviously, it's not good because then like you have a lot of customers, a lot of clients, and like you don't have like half of your menu is not available. Obviously, people will stop going to this restaurant because they cannot order whatever they want. They only have like lettuce with, I don't know, like cheese and stuff like this, like I don't know, like chicken, I don't know. They don't have maybe what they want. Obviously, it takes just one bad experience for the customer to never go to this restaurant again. So very important inventory turnover ratio for restaurants, as you can guess. And if inventory turnover ratio is low, it means that there is something wrong with the sales, or maybe there is a bad marketing, or maybe there is excessive inventory, which is the opposite to high inventory turnover ratio. And excessive inventory basically is the result of low sales or bad marketing. It means that manager is ordering too much. The manager is ordering so much inventory, but the company cannot sell this inventory on time. So warehouse gets bigger and bigger and bigger. It's going to get packed. So they need to basically either increase their sales or they need to reduce the amount of orders that they're making. And especially low inventory turnover, especially low inventory turnover ratios, especially bad for restaurants and groceries, because literally they have stacks of food, like it gets spoiled, it gets moldy, like the fridge gets molded. So like you get the idea, long story short. But there is one case when low inventory turnover ratio is good, and this is when you expect shortage of supplies. For example, low inventory turnover ratio. Once again, since it's very important for grocery stores and restaurants, let's stick on those two then, especially restaurants, because this for me is the easiest way to explain. So if restaurants, for example, yes, they know that rice, for example, rice can be stored a little bit longer than fresh meat and stuff like this. Yes, it's rice, like it's not a big deal. For example, for some reason, restaurant expects that there will be no supply of rice from, I don't know where they're buying, India, China, like any Asian country, I don't know, like wherever they're buying this from. So they expect, for example, that this country where they used to buy had a bad harvesting season, or maybe something else bad happened. Maybe the plane is like, the flights are restricted like we see it right now, or maybe the roads are covered in water so the trucks cannot pass. Something happened basically, okay? So they know that there will be no more rice in the nearest future. For this reason, if they have a low inventory turnover ratio in terms of at least rice, because you can also calculate for every single particular item individual inventory turnover ratio. It's complicated, but technically it is possible to do. And for this reason, it is good because you know that you have lots of rice stocked, basically. You don't need too much rice. Like you can kind of survive on whatever you are having right now. And you can calculate approximately how long you can survive on whatever you have right now. In this case, low inventory turnover ratio is good. So you can also plan. Maybe you can decrease the amount of rice you're putting in your portions. Instead of like 3 spoons of rice, like for your customers, maybe you can put like 2.5 or 2 spoons. So it's still there is rice, but not as many, and maybe not noticeable. So for this reason, you can decrease the price maybe, like, or just if you're not a very honest restaurant owner, you can just reduce the amount of rice and just sell it at the same price, whatever you want to do. But this ratio helps you to forecast and establish and estimate such things. Whew. Okay, no one joined, nothing in the chat. Don't know how long is left. I think we started at 15, so I think we have like 9 minutes maybe left. Wow, quick today. And last notes about fundamental analysis. Like I said, these are the last ratios that I'm personally using. Next, we will talk about Greeks like alpha, beta, delta, gamma, I think, like all this kind of stuff. But these are pure technical trading stuff. But if I'm not mistaken, I think beta is used. One of the next topics we're going to be talking about is discounted cash flow, discounted cash flow, and dividend discount model. I forgot DDM. Long story short, and discounted cash flow model, which is basically estimating the intrinsic value of a stock, which basically means estimating what's the real value of the stock. For example, intrinsic value of Tesla is, I don't know, like $50, but it's sold by $460. So real value, it's how much, according to fundamentals, price of the stock should be. Like, as you can see, it is barely like this, like especially in technological sector and stuff like this. But if you find a known company that Wall Street doesn't know about, that it's a very new company, it has great financials, and you calculate its intrinsic value, real value, and you see that it's supposed to be much higher than it is right now, potentially it can be a good investment for the future. And we will talk about this discounted cash flow model in the future as well. But what I was saying is that beta, which is one of the Greeks, it is used in the calculation of discounted cash flow model, basically, okay? So for this reason, I decided to talk really quick about the Greeks, and most likely it will be the next topic for our next week's presentation is the Greeks in investing and trading. But fundamental analysis, it does not use Greeks or anything like this, or at least like typical analysis for like regular investors, like long-term investors. But fundamental analysis is crucial for investing because you're investing in a company. You do not trade stocks, like you do not trade prices going up and down, extracting profits, short selling. No, you invest in companies. So for this reason, you invest in long term and you want to invest in a healthy company. Like traders are like, I don't know, like mosquitoes, blood suckers. They see someone is bleeding, they collect the blood, and then that's it, they're done with this company. This company starts bleeding again, they take it again. Or the company starts, I don't know, like eating a lot of food, and so there's so many leftovers, so they just take all these leftovers. So traders are like they're picking small things, but investors is you become part of the company, you grow with the company, you invest in the company, and obviously you wanted to invest in a healthy company that's going to survive, that's going to keep growing, and it's going to get bigger and bigger and make you richer basically every single year. So fundamental analysis is crucial for investing. Fundamental analysis can be both qualitative and quantitative. Quantitative, it's numbers related, and we completely finished quantitative part of fundamental analysis today. Quantitative, it's all these ratios like dividends, like activity, inventory turnover ratio, everything we've been talking about for the last 2.5 months or how long, I don't remember. All this were part of quantitative, part of fundamental analysis. While qualitative analysis is basically analysis of news, financial statements, future perspectives, like direction of where company is going, basically, and its plans and stuff like this. Fundamental analysis is very useful for short term because, like I said, you invest in the company that's healthy, that's like supposedly be bringing money to you in the future, that's supposed to survive through pandemics and stuff like this. Like, and if you analyze company for the short term, it will most like if you analyze a company, if you fundamentally analyze a company in short term and you plan to invest in short-term perspective, most likely it will not make sense because like it's short-term basically. Like in order for big companies to collapse or to completely change the direction of where they're moving, it takes very, very long time. They're like big like machines. It takes time for them to turn left, turn right, do a U-turn or whatever it is to keep going, and they just slowly keep going. So if you're planning to invest in something short term, which I'm not recommending, but not holding you from this, fundamental analysis is barely useful for this. It may show you that yes, company is good, but price will not reflect it immediately or within weeks or within months. It may take years sometimes for some investments to make basically sense. Let me see really quick if there is any more. Yes, I see something in the chat, but I'm not sure how much time is left. For some reason, Zoom started saying how much time is left and it just stops automatically for some reason. But let me see what you wrote in the chat before I continue real quick. Okay, DCF, Dude excited. I don't know anything about the Greeks. Only heard of alpha and beta here and there on the forums. So excited to learn something I don't know anything about. Yes. Okay, perfect. Then I was like kind of, how it's called, hesitating about should I do Greeks? Should I do presentation about Greeks or not? Because it's 99% of the Greeks are used for trading purposes. But since you're interested and because one of the Greeks is used in DCF model, and since you're excited for this, definitely I'm going to do the presentation about Greeks next one. Okay, and now more stuff about fundamental analysis then. More detailed fundamental analysis, the better chances at good investment. So basically, yes, like whatever I'm seeing on YouTube, these gurus, they saying they're just using, I don't know, P ratio, I don't know, like a current ratio and I don't know, dividend yield. Like, come on, I've been talking about quantitative part of fundamental analysis for almost 3 months. And this is just the quantitative part of fundamental analysis. You see how many ratios I potentially can use while analyzing a company. So like if the person is using just 3 ratios, like come on, like yeah, he might be right, he might be wrong, he might be lucky, but like in long-term perspective, the more precise your fundamental analysis, the better. Of course, you cannot predict what can happen in the future, like maybe CEO or top management will be corrupted or they will find some shady activities of them, and that's it. Like fundamental analysis in this case doesn't matter. It's something out of your control. But if everything goes according to the plan, the more precise your fundamental analysis, the better chances at making a good investment for the long-term perspective. And the last thing is the most detailed fundamental analysis. If you, for example, use every single ratio that I've been talking about, I think I have like, I don't remember, 29 maybe. Like in my arsenal, I have 29 ratios, I think, but I'm personally not using, I guess, more than 7, 8, maybe when I'm analyzing a company. It's like I was telling, if both companies are identical, then I will use more ratios to keep comparing them. But if I see that 7, 8, 9, 10 ratios is enough, basically it already tells me that the company is good. All the other ratios I can neglect because first I'm using the most important ratios, and in the end I'm using something already less important. Let's say so, like inventory turnover ratio for, I don't know, industrial sector, or for, I don't know, like technological sector. For these companies, it doesn't matter that much, like for example, for restaurants. And so, like I said, most detailed, if you use every single ratio of these 29 ratios that I am using, that I was talking about, it's not 100% guarantee that your investment will be 100% profitable and it will give you massive gains. It can only help you increase the chances of this happening, but it's not 100% guarantee because, like I said, you never know. Management can get corrupted in tax evasion, I don't know, or engaged in shady activities, whatever. Like, yes, you never know what can happen. Or for example, like very big competitor innovated super extremely like next level chip, like for example, I don't know, if we're talking about Intel or AMD, and that's it. You never know what's going to happen, but if everything goes according to the plan, if everything goes whatever is supposed to basically happen, detailed fundamental analysis helps you to increase the chances of finding such good and profitable investments. And I think that's it. That's it with quantitative part of fundamental analysis. If you have any questions right now is the good time. Next time we'll talk about the Greeks, alpha, beta, delta, gamma, and I think that's it, like 3 or 4 of them, not that much. So just the very basics. Because I don't know how much time is left. So excited to learn. I don't know. I have zero knowledge. It was the same for me. No one is born knowing everything about investing. It's like it's learning process. Even I am personally, when I'm reading some new books, listening to audiobooks, I mean, listening to podcasts about investing sometimes, or watching YouTube investing YouTube investors, or how it's called, for personal finance people, not like investing gurus, like I'm talking about Graham Stephan, Andre Jig, like on all this, like you know them basically, yes, like those kind of people. And there's always maybe something new that I learn. So Buffett even says he's always learning something new. Like for him, it's very, very little left to learn, but he still can learn something new. So it's okay. As long as you're willing to learn, and as long as you understand the importance of this, because this is investing, this is like your personal finances, your mind is your retirement money. As long as you understand all those things, that's all that matters. And everything will be good. And I see that you care, you understand, and you know it.
Yeah, man. Thank you.
Yes.
I opened a couple positions today, like single stocks. So I'm starting to make my own picks instead of relying on the ETFs.
Mm-hmm.
I got Google, Microsoft, and some Apple now.
No, these are technological companies. So, and as long as it's diversified with your among it's as long as those companies are among your ETFs. So, I mean, it's not that you just sold your ETFs and just hold those three companies. I guess that's okay. Like individual stock picking with the having some other diversification, either through ETFs or in other sectors. That's okay. Like that's fine by me. Like. So, like I said, we are young. We still have lots of time to be investing. We can be more risky than average right now, so that's okay. And these are good companies. Like, yeah, they might be overvalued, but these are like companies like Google, Apple, Amazon. These are the companies that come on. Like Amazon is like everything we're buying right now is almost on Amazon, at least in the North America. What else? Like Apple, like also the whole North America almost uses Apple products. Same stuff with the Google, like even not just North America, almost the whole world uses Google as their how it's called browser, web browser. So yeah, those companies they might be overvalued, but those are the companies that gonna be here for very, very, very long time. And if something bad starts happening with them, like we will know about this, and by that time something bad starts happening, our initial investments that even if we make them today most likely gonna be already higher. So it's all good. Good decision, good investments. Good luck with them.
Thank you. Thank you for giving me the confidence too.
Yeah, of course. Investing is all about like confidence, and you need to like your investments. Like for example, you cannot hold a company which you do not like personally, because as soon as you see this company getting falling, let's say so, the whole week in a row, you'll be like, come on, this bad company, I'll just sell it, even though this company might have a good financials. But you just need to like your company. You need to have the combination of the company is good financially, and you like to have this company in your portfolio. So you can ignore sometimes when the price goes down, you can ignore this because first of all, you know that financials are good, and this company just personally like you, and it helps you to ignore such short-term price volatility and stuff like this.
Right. And yeah, the very, overvalued today, but 30 years when I go to sell, probably grown by then. So by today's standards, yes, overvalued, but undervalued in 30 years in the future, probably. I'm hoping at least that.
Most likely, hopefully, yes. Most likely, if those companies are going to be still as massive and influential as today, 30 years from now as today, most likely the prices will be higher than we see right now. So basically, that's all there is to it. Okay, I guess. Unless there are some final words, I'm not sure how much is left. It doesn't show me once again. But according to when we started, I think it's about to end any single minute right now. Thank you always so much for joining every single time. Thanks so much. Hopefully next time we see more people like Gabriel, nice guy, and Diego as always. And we start Greeks, and then we start qualitative part of fundamental analysis someday in the future. Okay, have a good rest of the day. Thanks so much. Bye.